Good evening to members who have registered for this program on practical issues on accounting standards relating to financial closures. Friends, I'm CA Naresh Chandragali, Secretary of SIRC. I welcome each one of you to this virtual program to address this topic on practical issues on accounting standards relating to financial closures. We have R. Sundararajan sir. CA R. Sundararajan is from Chennai. He's a managing partner of SRBR and Associates, a firm with more than 3 decades of practice and having offices in Chennai, Hyderabad, and Kochi. He's a qualified information systems auditor from the Institute of Chartered Accountants of India. He is specializing in the areas of audit and assurance practices. He has been addressing almost all the branches of SIRC on the topics of bank audit, audit and assurance standards, accounting standards, tax audit, corporate audit, due diligence review, code of ethics, etc. He is a visiting faculty in the Institute of Cost Accountants and Company Secretaries, C&AG Office, Staff Training College of RBI, Indian Bank, and Indian Overseas Bank. He has co-authored a book on bank branch audit released by Chartered Accountants Study Circle, Chennai. He's been a part of a group of groups of ICAI on various topics of professional interest on guidance note revision, corporate audit, auditing and assurance standards, to name a few. He's been co-opted to various committees of ICAI at central committees in Delhi and also at various regional council committees, to name a few, on corporate laws, committee for members in industry, CP committee. He's worked as a convener of the Chartered Accountants Study Circle and have conducted many workshops, seminars, and annual conferences, and also residential refresher courses across South India and all over India. He has held the position of Treasurer, Secretary, Vice Chairman, and Chairman of International Fiscal Association Southern Region Chapter. He's been actively involved in Lionism and as regular blood donor and has consistently contributed for various social needs of the society. Friends, this is very small profile of C. R. Sundararajan. I know him personally. He's maybe if I can say, has a lot of knowledge on some of these topics and is a very contributor. He gives a lot of ideas and suggestions to a lot of young members and has been a very good giver. So, knowing him personally, I think he's a rich resource person to the Chartered Accountant fraternity. He's been traveling across South India for more than 10 years on the topic of bank audit. And the month of March, he and his partner travel all across South India, but for this COVID. And by the end of the month, their throat would have been choked off. So they have a passion to train and educate the members. So with this very brief profile and information which I can share with you, I welcome C. R. Sundararajan and I request him to address the members on the topic of this India standards. So welcome to Sundararajan, sir.
Yeah. Thank you, Naresh, for the sweet and pleasant words. I'm sure that I will try to stand up to the build-up you have created already. Even though many members have heard me earlier, each and every occasion, it's a different issue altogether. And now we have to address this AS 15 and AS 9. That's what I have been asked to address today. It's a good opportunity once again to share a few of my thoughts. Let us be very, very clear. These two standards have been settled for quite some time. So we don't have anything to say. That's what we always feel. But each and every time we go through the provisions, we find something or other which is coming up afresh. And we will have to keep on thinking on the issues various which is happening in respect of all these standards. So the point is, we need to go through the standards of AS 9 and 15 today with an open mind to ensure that whatever we have learned, we will keep learning again and again, because there is nothing great new about this, but each and every technical issue has to be absorbed in a detailed manner. And probably the audience here may be having few of the newcomers or recent chartered accountants who might be able to pick up certain items from this. I will be too very happy if at least 10% of the people are able to pick up a new thing from this, and probably another 10% of the people give me some new things, because always I feel that each and every lecture or each and every session is a learning session for both sides, both the audience as well as the speaker, because whatever we speak, definitely there will be some value additions from the other side, which you'll always be looking for. So this is what I always say, that whenever I have some sessions, it's a learning session for both of us, and I want to have as many inputs from the audience also. Since the session is divided into two specific standards, AS9 and 15, I'll go to the AS9 first, and probably I can pick up certain questions in between if it is required, which will give a small amount of rest for this throat, as Mr. Naresh was telling. Because whenever we go for the faculty sessions in the month of March, we'll be continuously traveling. So next month, we will be keeping a Mauna Vratham for at least 15 days. Then only our routine procedures will come up. So I would like to have my slide to be started. Naresh, my slide is seen?
Yes, sir, visible, sir.
Okay. Okay.
Visible, sir.
Yeah, okay, fine. So basically, thank you very much once again for this opportunity, and let us go through the slides in a detailed manner. Yeah. So I have structured the program in such a manner with a brief overview of the accounting standards, because I am just taking hardly 2-3 minutes on this particular area. What is an accounting standard? Even though all of us know about what is an accounting standard, but it's basically in the three pillars of accounting, which is recognition, measurement, and disclosure. Whether a standard is required for all these things, because all these things have been set for a long time. But even then, whatever be your thought process, let's be very clear why this accounting standards is required. The accounting standards play an important role. See, a portion of this is already read and understood, but still we'll have to go through that in a detailed manner. It gives a uniform preparation, because A company is there, a B company is there. Whenever a particular transaction happens, if A is also working on the same line and B is also working on the same line and giving a certain level of disclosure, it has to be comparable. That is the ultimate aim. The readers of the financial statements has to be equipped in such a manner that he understands A as same and B as same, unless otherwise there is a significant difference between the transactions of two different organizations. Ultimately, the financial statements have to be understood by the reader of the financial statements in a proper manner. What do you mean by a proper manner? Whatever be the presenter of the financial statement, namely the companies or corporates or non-corporates as the case may be, whatever their intention is in respect of the financial statements disclosure, the reader also have to understand in the same language. That is the intention. For doing that, if Mr. Sundararajan is preparing a financial statement of a construction company and Mr. Naresh Gali is forming financial statements of another construction company, both of them have to be having the same line of thought process. For that only these accounting standards are required. If I am going to have the recognition of revenue on a different methodology and he is going to start on a different method of accounting as far as the same flat construction is concerned, then the readers will not be able to understand that whether company A is performing properly or company B is performing properly. Why you will have to go through this performance and appraisal? Basically, all of them are stakeholders, maybe a banker, maybe a regulator, maybe a shareholder, maybe enforcement agencies also. They should know the respective financial statements, whether it is reliable or not, and it is comparable or not, and whether it is in accordance with the standards for which we require accounting standard. And obviously, whenever you talk about accounting standard, the immediate thought process which will come into is materiality. What are the items which you are talking about? If it is not material, accounting standard does not recognize that to be done at all. What do you mean by materiality? That's a different auditing standards for the purpose of determining the materiality. But normally we understand that whenever financial statements are being taken for computation, a specific level of percentage, let it be 1% or 2%, less than that, it will be effectively immaterial. And there are lots of organizations, when they finalize the financial statements, they have a materiality quantum itself. Beyond that, they will not be required to do any changes at all. Many of you would have done bank audit wherein they would have said that less than 10,000 rupees don't pass any journal entries. We do consolidation for a lot of international companies wherein they say up to 1,000 euros, you don't have to pass any fresh entry at all, unless there is a requirement. There are certain corporates, listed corporate abroad, who has lots of units in various countries. One of that, if it has happened to be in India, the turnover of this company will be around 50 crores, but globally the turnover will be around 1,000 crores. In that situation, they will say any transaction less than a crore itself will be immaterial. So they will suggest that in case of any specific deviation from the standards, you don't have to mention if the amount is less than this particular amount, maybe $1 lakh or $50,000 or $10,000, as the case may be. So the materiality you will not be able to determine at the one stroke for everybody as a standard. It depends on the company to company and corporate to corporate. And as I always told you, the representation of the financial statements has to be relied upon by all the stakeholders for which it is required. And imputation of substance over form. What do you mean? This is a very, very important concept which has to be understood. Unless and otherwise we understand the substance of each and every organization, the form alone is of no relevance. Form is being given only for a guidance for us. Unless and otherwise you understand the substance of each and every organization, we will not be able to complete the format, which is the financial statements of Schedule 3, or as the case may be. That has to be prepared only in accordance with substance. Neutrality, prudence, and completeness. Very, very important concepts. Prudence is one particular item which is very, very important as far as accounting is concerned. Need not be for this standard or any standard for that matter. As far as accounting and auditing is concerned, the prudence is a very, very important point which has to be thought of, which is given in each and every accounting standard which is being discussed by all the professional fora. Completeness. Ultimately, the intention is the financial statement which is being given has to be complete in all their aspects. There should be neutrality. It should be prudent. The substance over form has been taken care of, and if there are any material differences, that is being absorbed or reported properly. If these things are there, we can reasonably rest assured that accounting standards are being properly followed. And obviously, the last one which I have told you, comparability of financial statement contained therein. That is comparability of the financial statement between this year and last year, comparability of financial statement of this company with another company which is of the similar nature. Need not be compared with, we don't have to compare apple with oranges, but one apple with another type of apple we have to compare, and according to that, that comparability is important. If these natures of items which is being properly followed, then we can reasonably say that accounting standards are being followed. Having given a small preamble about this accounting standards per se, let us go into what do you plan to cover in AS9, which is my subject today. Because the first two slides does not have any specific question for me, because these are all standard accounts which all of you know. So let us go into this coverage. What are the things I am doing to do? As far as this AS9 is concerned, origin, scope, and applicability. What are all the exceptions? Because whenever a standard is given, definitely there is an exception given, because we chartered accountants always look for an exception first. In not only chartered accountant, anybody for that matter, whenever we say that this is applicable to you, how it is going to be exempted for us. For example, if they say you are liable to be given COVID injection or this COVID protection injection, what can be my cause for an exception? This is what always look forward, leave alone the accounting standards. Same way, the accounting standards also, what is the scope available and where it is exempted, that exceptions will be seeing. Definition and measurement, very, very important. Unless we understand the definition of revenue and how it is going to be measured, there is no point in going through the accounting standards. And the next one is timing of revenue recognition, very, very critical. Let us understand for a moment what is revenue. And not only understanding the revenue is important, when is it to be recognized is very, very important. Because if it is not, what is going to be recognized on 31st of March, if it is recognized on 1st of April, it becomes a different accounting year. What is to be recognized in the month of April, if it's accounting in the earlier years, which means it is escalation of income or increasing the income or inflating the income. Both are not right. What is the timing of the revenue recognition is very, very critical, both in respect of sales and services. Not only these two items, any other items of revenue also. We'll go through that in that particular slide. The next item is what is the disclosure requirement. As I told you in the first stage, accounting standards is in respect of measurement, recognition, and disclosure. These are the only three items, which is the ultimate aim. Naresh, speed you can control. If I am going on a bit speed or whatever it is, you can just tell me. I will not be able to interact with all the audience. So any specific office bearer who is there can tell me whether it is okay. This disclosure requirement will be mentioning about. Yeah.
Sir actually disconnected. Actually, he said he'll be joining a little bit later due to internet connectivity issues.
Okay, doesn't matter. If this, if there is any specific disturbance, you can tell me.
Yeah, I'll let you know. So I'll be there throughout the session, sir.
Yeah, okay. So next is disclosure, and after the disclosure, important topic which is issues, because whenever some accounting standards is there and which is being applied, and when we disclose something, definitely each of us will be raising up with certain issues. This is the critical portion of the entire session, where I will be able to raise certain issues out of my past experience and also by way of interaction with various members over a period of time. Because how an issue is raised and how is it resolved is very, very critical important. And the last one is illustrative disclosures, because obviously there should be a standard which is being set by various listed companies. Whether all those standards has to be literally followed by each and every one of us, it is ideal to do so. Because when Infosys does a disclosure or a Tata consultancy does a disclosure, they do a lot of research and then only they go to the disclosures, and it has been proven. Obviously, each one of us are willing to get emulated, or we want to emulate a higher person, which is priority. Always we would like to emulate the best practices. So I am just bringing certain illustrative disclosures. Not possible to disclose everything, which is not possible. It's available in the domain, public domain. But I will just pick up few disclosures which I thought which are very good and important. This is how I am planning for the coverage today. Let us go through that. All of us know that AS9 has been brought in by ICAI in 1985. And after that, originally it was not specifically given for any corporates or whatever it was given for all the organizations. Then Companies Act brought in their own accounting standards by way of AS rules in 2006, in which they almost adopted what has been given by the Institute of Chartered Accountants of India. After that, there were some modifications, but it's almost on the same line. So as far as all of us are concerned, there are around 29 standards which are there, which are mandatory. 30, 31, 32 is not a mandatory. So what is the scope? The standard of this AS9 deals with revenue recognition and circumstances where revenue recognition can be postponed. There are 2 points in this which you'll have to understand. One is whether a revenue is recognizable, first of all. When should we recognize? And if it need not be recognized now, when is it going to be postponed? These are the 3 items which has to be considered for this particular accounting standard. So this is the scope as far as this AS is concerned. Where it is applicable to all enterprises. As far as AS9 is concerned, it is applicable to all enterprises, level 1, level 2, level 3, as far as ICAI standards are concerned. And AS rules 2006 is concerned, it is applicable to all corporates. There is no exception at all, except where India is applicable. Where India is applicable, this AS9 will not come. So we'll have to stick to the India AS 38. As I told you in the initial stages, what is the exemptions which are available? The exceptions are available in respect of these particular standards. Revenue arising out of construction contracts. So whenever there are some specialist activities which happen, special standards are being given. For example, in case of a construction contract, when I do a normal trading activity or a manufacturing activity, all of us know when I buy an item for 10 rupees and sell it for 12 rupees, once you do the sale, I do the recognition. But construction contract is not like that. It is a process which is spread over a period of 2 years or 3 years, as the case may be. In case of trading activity, I buy and sell immediately. In case of manufacturing, I buy raw materials, process it and sell it. There is a specific limitation of working capital cycle. Same way, it is one product which is being dealt with. Whereas in case of construction activity, it is multiple flats which is being done, or multiple lands plots which is being done. So in respect of those items, there's a separate standard which has been given, which is AS7. So wherever an organization has construction contracts with that, be it flat promotion, be it bridges, be it infrastructure projects, AS7 has to come, and AS9 will not come into the picture as far as these companies are concerned. Second item is hire purchase and lease agreements. Wherever hire purchase and lease agreements are there, specialized contract by way of AS19 is there, which will deal with revenue recognition. I'm talking about the leasing companies. As far as companies which are taking up on lease, there it is an expenditure recognition, for which once again I will have to go for disclosure requirements and AS19. But as far as the revenue recognition is concerned, the leasing companies and hire purchase companies are exempted from AS9, where they will be going through that AS19. And the third exception is by way of the government grants and subsidies. So there are lots of non-profit organizations or even profit organizations get some grant from governmental activities. So in those cases, we will not be able to have the same policy like AS9. There a specialized treatment has to happen, for which AS12 has been issued. So we will have to do the revenue recognition according to that AS and not like AS9. This is the third exception. Fourth exception is insurance companies arising from insurance contracts. They have their own standards through this IRDA, etc. That also AS9 will not be coming into the picture, because the insurance claims, insurance premium collections over a period of time, it has an impact. The actuarial valuation will be happening. All these things will come under as a specialized activity. So we will not be going through the normal AS9. And the last one is exchange gains, realized and unrealized, which is coming under AS11. So there also, that amount, that recognition has to happen according to AS11 and not according to AS9. These are the various exceptions which are available. Just to sum up, accounting standards 9 is applicable in respect of all corporates, all levels of enterprises, 1, 2, 3, all of them it is applicable. The exceptions are only in respect of construction companies, leasing companies, insurance companies, government grants and subsidies, and exchange gains. These are the things which are going to have a exception. Next item is we will go through these definitions. What do you mean by revenue? That is a critical definition which we will have to go through that. Revenue means inflow of cash, receivable, or other consideration arising in the ordinary course of activities, business activities of an enterprise. So there are three components. One is there should be a cash flow or a receivable or any other consideration, because once you don't have a cash flow, you cannot say that thing is receivable. Once you do on a credit sale also, the revenue has to be recognized, because there is an amount which is going to be received subsequently. When there is a barter activity which has happened by way of an exchange of transactions also, in those cases also the revenue has to be recognized. So that is an item of inflow. Even though there is no cash flow at all, there is an element of other considerations which is being received. It has to be in the ordinary course of business. What do you mean by ordinary course of business activity? A company which is having a manufacturing activity has a factory also. The factory does production of equipments, etc., and it is being sold. So what happens is I buy raw material, convert into finished products and sell it. That is my revenue recognition. If the same factory company has 2 or 3 factories, and one of those factories they sell it to an outsider, in that case the sale of the factory as a whole is not in the ordinary course of business. That is one-time transaction which is happening. There AS9 will not be coming to the picture. It will be a different transaction altogether. So for applicability of AS9, I have to have a revenue which is being generated from the ordinary course of business, which is day-to-day activity of that particular company. For a flat promotion company, selling flats is revenue recognition. AS9 will come. Of course, AS7 will come, but the revenue recognition concept will be there. As far as the company, which is production activity, AS9 will come in respect of that production activity, in the same way trading activity as the case may be, or servicing company. But whenever they are dealing with assets, whenever they are dealing with other grants, etc., this AS9 has to be kept aside. So we'll have to see sale of goods, rendering of services, and also use of enterprises resources of others by yielding interest, dividend, and royalty. Because when I say I purchase and sell, when I say I produce and sell, when I say I recruit people, do services and then sell, all these things are sale of services and sale of goods. But there is definitely one more element of revenue which is being generated by the organizations. by way of surplus money invested in bank deposits, surplus money given as loans to outsiders, surplus money which is invested in dividend earning income also. Those income also has to come in AS9 only. Even though it is not in the ordinary course of business, it is ancillary part of business, but it is part of the business activity only. So those income also will be coming as revenue recognition. So we would like to say all the three items are very, very critical as far as revenue recognition is concerned. One is sale of goods, next is rendering of services, and third is my resources being utilized for some other activity which is generating interest or generating dividend or even royalties, because a manufacturing giant will have its own domain of what you call patented product, which they give it on another person to do a production, and they take royalties. Measurement. First we said what is revenue, and then we said what is the definition, and then we'll have to go for the measurement. How do you measure? It is measured by the charges made to customers or clients for goods supplied and services rendered to them. So whenever I say I am having a computer production company, I sell the computer. So what I am selling it is a computer, and the computer is costing anywhere between 15,000 rupees to 50,000 rupees. That is the amount which is being measured by the company which is having that product, by estimating what is the cost involved into that organization or involved into that particular production, and what are all the developmental activities, what is my initial expenditure which has been done for capital, all these things combined together. I estimate this is the value of a particular product, and that amount which is being charged to the customer by way of invoice, that is the amount which is revenue, just to be measured by us. It is in respect of sales. In respect of services, by the charges and rewards arising by way of use of resources by them. That is, I have my own resources. Take the case of software company. I am having my own resources of software staff, which is generating software, and that software we are going to provide to the another company for doing their day-to-day operations. For that, we levy service charges, we collect it. This is one example which I am telling you. Other same way, we can have manpower resources. That manpower resources we deploy for organizations. For example, there is a company which will be utilizing contract laborers. So I supply the laborers. For that, I collect money. That is the services. I have an advertising company. I provide advertisement services or marketing services to a company, and I take charges. That is my revenue. So in respect of sale of services by way of either advertising services or manpower services provided, consultancy services provided, all these things is also by way of a revenue to be recognized, and that is the way it is being measured. On the basis of my time spent and all these things, I have to do the measurement. In case of an agency relationship, commission is basically an amount which is going to be generated as revenue, particularly in respect of consumer durables. In the respect of consumer durable trading activity, there will not be any purchase and sales. They keep them, that is, the manufacturers comes and place in the agency's place, they sell it, and they generate a revenue out of it by way of commission. For each and every TV, they will be having a fixed salary of 1,500 rupees or 2,000 rupees as commission. They will not do the buying and selling. The manufacturer will come and place the products here, and on that basis, once they do the sale, the commission will be recognized. It's basically something like a consignment agent or whatever it is. These are the three items of measurement which is going to happen. Okay, having understood what is the measure, how do they measure the income? When is to be recognized? Timing is very, very critical. The revenue from sale of goods and rendering services should be normally recognized at the time of sale of rendering services. What do you mean by sale of rendering services? First portion, it has come to the sale of goods. When do you recognize the revenue by way of sale of goods? Is at the time when the risk and reward gets transferred. If I have a product and I am going to sell it to another company called B Limited, the time my product is going out to his risk, that is originally when it is my product, I keep it with myself. Once I do an invoicing, and once the invoicing is done and transferred to the product to them, the risk and reward is getting transferred. The timing of the place where it is risk and reward is transferred is critical for ascertaining the revenue. We will take few examples for this at a later time. I will talk about issues, but one or two examples now itself. A company is there. They do manufacturing of machinery. They dispatch the machinery on a particular date. Let us assume for a moment 31st of December 2021, they dispatch the product. When do they have to recognize their revenue? On 31st of December, when they dispatch, they have to recognize the revenue. But only thing is, you have to see the condition, the invoice, whether it is we will have to go through the contract of transaction between the buyer and seller, say a purchase order or sale order, when the risk is being transferred. Once it is transferred at the time of dispatch from my factory, I have to recognize the revenue at that point of time itself. If the condition states that I have to deliver at that particular person's place, then I have to recognize the revenue at that point of time. There is a third limb which is to be there. I have to manufacture, supply, and then do the installation. Only after the installation, revenue has to be recognized. So it is not the timing of recognition has to be done uniformly in respect of all the cases. Timing of recognition depends on case-to-case basis. In case of sale of goods or trading items, which is trading simplicities. So in that situation, once I do an invoice and the other person takes responsibility of the product by way of delivery, there ends the sales. Take the case of organizations like various retail traders like Vasant & Co or Vivek & Co as the case may be. What happens is they do the invoice and keep the product ready for dispatch. Sales is recognized at that time itself. The dispatch is an independent activity. It's not linked with the sales. But if the same case, if they have undertaken to install your air conditioner in your house, until the air conditioner installation happens, he cannot recognize the sale because that installation is part of the sale activity, even though they are two different activities for the same. That is why if you understand all this trading activity, they do the recognition and sale immediately on the same day. They don't even defer to the next day. Point of revenue recognition is at the point when the risk and reward gets transferred. I'm making it very, very point blank. When is the risk and reward transferred? Risk and control of goods is getting transferred. On that day, the revenue has to be recognized. However, if there is a significant uncertainty of ultimate collection of revenue, then the revenue recognition should be postponed. What is the classic example for this? Classic example is, I am doing the supply today. The other person, as per the contract, makes it very, very clear that you supply it, you install it, it has to function properly in my place. If I don't function properly in my place, I will return the product to you. If there is a condition like that, in that situation, until it is being supplied there and implemented properly, straight example is, let us talk about water treatment plants. Water treatment plants are supposed to be installed in the respective place and prove that it is treating the particular element at that level. It is being used in the various hospitals, etc. for distilled water supplies. They go and put the plant there. The hard water has to be converted into soft water at that particular level. If they are able to prove that, then the machinery can be installed. Otherwise, the machinery has to be taken back. So when there is a significant uncertainty of ultimate collection of revenue, there also you don't have to recognize revenue, number one. Another item is when I am supplying to a particular company, where that company either even after supply or before the supply, once I do a supply on a particular date, after 4 days, it becomes the organization becomes insolvent, or as the case may be. Take the case of latest case of ILFS. I have done a supply on 31st of March of a particular year, and the company became defunct on 4th of September, 4th of April or 5th of April. When I sign the financial statements, I am 99.99% sure that the money will not come. In that situation, I don't have to write off as a bad debt. Normally, what we do, once we prepare a financial statement, events occurring after the date of balance sheet will come into the picture, come into the play now. By the time I sign the balance sheet, the uncertainty is already established. I don't have to recognize the revenue at all. I can postpone it. I can postpone it. I can defer it because the product may come back to me if they are not installed or as the case may be. The other option which is available for me is to account for it and then write off as bad debt, which will happen only if the accounts is considered as bad debt after the financial statements are signed at a later date. We understand that it is not recoverable. This is the second example. First example is we will not be able to get that money surely unless we install to the expectation of the purchaser. If it is not performing at that level, it may not come at all. I have to return it back. So I will recognize the revenue only after that is being done. The second option is companies to which I supply, they become insolvent or at some reasons or other, if they are not able to pay the money, there also I need not recognize the revenue. Once again, it is similar to exception. Normally speaking, I will have to provide for consider the revenue recognition once the risk and control passes on to the purchaser. I have to recognize the revenue. The exception is when there is a significant uncertainty, I can postpone the revenue recognition. One more item is in respect of infrastructure products, infrastructure projects, where I am doing a supply of large items for various organizations until that is being performed there and established. And one more example is it has to perform for a specific period of 3 months. Then only it will be considered as a sale. Otherwise, it will not be considered as I'm having the eligibility to return back the product. In those cases also, I don't have to recognize the revenue. These are the conditions which I was telling you. Seller has transferred the ownership of goods to the buyer. All significant risk and rewards have been transferred to the buyer. I have to recognize the revenue. Second option, seller does not retain effective control or ownership of the goods. There is no significant uncertainty in collections. In these cases, if these conditions are satisfied, I have to recognize the revenue. Number one, the entire risk is transferred. The seller does not have any control of the product because the entire control is given to the buyer, and there is no significant uncertainty of collection. Straight away recognize the revenue. This is in respect of sales which has been examined in the earlier occasions also. Next is regarding rendering of services. Revenue from services is generally recognized as the service is being performed. The performance is measured by two methodologies. One is by way of completed contract method or proportionate completion method. This is not AS7. Please understand, this is slightly different from AS7. AS7 is only in respect of construction contract, where also we have a completed contract method and percentage of completion method. I'm not coming into that angle at all. This is in respect of provision of services, which is being measured by two methodologies. One is completed contract method and proportionate completion method. I always go with the examples. The reason being, once you understand the example, you will be able to understand the concept also. I have a software supply which is to be done in respect of a particular thing. I am doing an implementation of ERP for a particular organization. In that situation, it is a service which is being provided. There may be some various points of recognition of revenue. So each and every time of, say, there will be milestones. There will be milestones, predetermined milestones. And each and every milestone, I will be recognizing a revenue. So in that is coming under proportionate completion method. The other method of computing that is, I make a service, I supply it, get that money at one stroke. That is called as completed contract method. So for the same software, I can have two methods of computation. Basically, it is between the contractor-contractee arrangement only. If the supplier of the servicer and receiver of the servicer agree that I will have to supply in full and then only take that money, then the money which is being received will be shown as advances only. It will not be recognized as revenue. But wherever the agreement is by way of milestone reaching, whenever the milestone is reached, the 20% milestone for a specific level, I can take the revenue. Same concept can be applicable in respect of any services which being let it be manpower supplies done, or it can be by way of consultancy services. For example, even a charter one for that matter, when I'm providing a services of preparation of appeals and filing with the Commissioner of Income Tax or tribunal as the case may be, I can have milestones. I will prepare the appeals and give it back to you, for which an X amount will be given. Once I apply for Commissioner of filing the appeals, I will be charging an X amount. And while appearing, for each and every appearance, I will be charging. These are the three stages where it is being done. This is one method of revenue recognition. This is as per the contract. The other contract is I take in turnkey object, I complete everything, I complete this project, and then once the final hearing is completed, I will be recognizing the revenue. This is the second methodology. So as far as revenue service is concerned, it depends on completed contract method and proportionate completed method. At this juncture itself, I would like to raise an issue for the members' benefit. This proportionate completion, completed contract method may not be accepted by two organizations. One is GST organization, who always say even the advance money received is liable for GST. Whether you recognize the revenue or not, I am not concerned. As long as you receive the money, you are supposed to pay the GST to us. Normally, what we understand is only when we do a recognition of revenue, then only the GST will be applicable. But in this case, GST will be applicable in respect of advance money received itself, and it is not going to be left by the department. Second portion is ICDS. Even in respect of direct taxes, I may have my option of having recognition of revenue only when the project is completed. But ICDS says that in the AS9, they say that it has to be considered on the income tax computation. For income computation for the purpose of disclosure requirements, it is not for our accounting. It is for the purpose of ICDS for the assessment of income. They will insist on the proportionate completion method. So there will be an issue between the accounts and the returns, which we have to balance at that point of time in case of revenue from services. This is what I was telling you. I have explained to you completed service contract and proportional company. It is various degree of completion of services, maybe on the percentage milestones. Basically, it's a milestone. So after sale of goods and sale of services, the third important item is my surplus money invested with another person, which may generate interest, royalty, and dividend. Interest is accounted on accrual basis, on time proportion basis. We'll have to make it very clear that how the interest is being computed. For example, in fixed deposit with banks, it will be as per the contracted rates on time proportion basis. In the same way, interest on loans given to various parties, there also it will be on time proportion basis and accrual basis it has to be provided for. In case of royalty also, it is on accrual basis, but as per the terms of the agreement. Because the agreement will specify when the royalty is payable and what point it has to be paid. That is, once the manufacture is completed, I will have to be paid, or the manufactured products are ultimately sold to the respective customers, then only it has to be charged. Once again, it is on the basis of the agreement which is being signed between the patent provider and patent receiver. Third is dividend. As far as dividend is concerned, normally we understand that the dividend is taxable on as income from other sources. It is on receipt basis only. But as far as corporates are concerned, or even for non-corporates, as far as AS9 is concerned, when the right to receive the payment is established, dividend has to be recognized. When is the right to receive dividend payment is decided? It is the time of declaration of dividend by the respective companies. That is the company where I have made the investment. Once the right is decided, I have to declare. I have to account the revenue or recognize the revenue as the case may be. So what is the disclosure which is required? As I told you, there are three limbs. One is measurement, another is identification, and third is disclosure. So what do you have to disclose? I have to disclose the exact method of recognition of revenue along with the timing of the event. I will show you model classes which is being given in various companies, which is wrong, and also how it has to be written correctly. And when the revenue recognition is postponed, the circumstances necessitating the postponement has to be disclosed. Without proper justification, I cannot defer or postpone the revenue recognition, which is otherwise should have been recognized. Both items are required to be disclosed, and only on that basis the accounting standards are supposed to have been followed. So after measuring, after identifying what is the revenue to be recognized, and after computing the revenue to be recognized, how it is disclosed is very, very important. Unfortunately, we are on Zoom. If we are on, I'm not Zoom, I'm talking about virtual platform. When we are in personal classes, I may be able to understand how many of you are understood or whether my concept has been reached or not. Unfortunately, we are not able to do it. This is the difficulty of information technology utilization. If you have any specific questions, you can post it in the question box. Probably the organizers may be able to throw these questions on me either during the break or even after subsequently. By the end of the session, I have given my mail ID. If you have any specific questions, you can put email also. I'll be able to respond as early as possible. Sorry for the inconvenience. I don't have any other option. I'm not able to see physically how the response is happening in the audience level. After having told the measurement and also on the how the disclosure has happened, I would like to mention what are all the issues which happens in the normal course as far as accounting standards 9 is concerned. Sale is in respect of the sale of goods, delivery is delayed. Buyer takes, I'm not able to see the slide properly.
I can see a slide, sir.
Yeah. Delivery is delayed at buyer's request and buyer takes title and accepts billing. What happens is when the buyer is specifically instructing, for example, let us understand for a moment, my buyer is in Ukraine today. Buyer will say that as far as I am concerned, your product is completed. I have come and done the inspection. I am acceptable to you. Please do the billing. Go ahead with the billing. I take the risk. But only thing is, don't dispatch to me. You keep it with you because here the world is disturbed here. Don't send it. In that situation, even though the product has not gone out of my pocket, out of my factory, it has not been completed. Even in that situation, I have to recognize the revenue because the risk is transferred or control is transferred. Today onwards, the insurance is on account of that particular person. The concept which has to be understood is, in case something happened to the product today, who will be responsible for that? Whether the insurance claim will go to the buyer or the insurance claim will come to the seller. Even though it is in my factory, if the insurance damage happens, it will go to him or to me. If it comes to me, revenue need not be recognized. If it goes to the buyer, revenue has to be recognized. The point is very, very clear. This is a classic example of you can take the Ukraine concept today. If the delivery is delayed at the buyer's request and buyer takes title and accepts the billing, he accepts the billing, he accepts the risk and he does the insurance coverage, etc. Even though the product is not going out of your factory, it should be recognized as revenue. This is one particular issue I thought of raising in case of sale of goods. Next one is delivered subject to conditions. There may be a lot of conditions attached with the purchase of good or sale of good. Installation and inspection, which I was telling you in the initial stages also. For example, a water treatment plant. The revenue should be normally recognized until the customer accepts delivery and installation and inspection is complete. That is, I have one classic case in my own client where they have supplied, I'm talking about an organization which has purchased machinery. The machinery has not been able to be installed properly in India because of various technical issues. The supplier has said that he has not recognized the revenue. The reason being, I have not been able to accept that installation is complete as far as I am concerned. When I am making clear that I have not accepted because that inspection is not complete, installation is not complete, the other person cannot recognize the revenue. Why? The reason is, if the installation and inspection is not properly done, ultimately the product is of no use to the buyer. He'll be dismantling the same thing and sending it back to the original supplier. In that situation, there will be a dichotomy wherein the product will be supplied. I would have taken it, I would have returned it. Instead of doing it as a sales return, it need not be recognized as revenue at all. Once again, this will happen only in respect of certain specific products. It will not be on all the cases. Certain specific products, it will be subject to condition that installation inspection has to get completed. If it is not completed, it may not be having relevance. Next is on approval. That is, your revenue has to be recognized only on approval basis. Revenue should not be recognized until the goods are formally accepted by the buyer and buyer has done an act adopting the transaction. The time for period objection is elapsed. That is, take the case of Amazon. Amazon, all of you will be definitely buying from Amazon, I'm sure. So from Amazon's point of view, he sends the product to you with an invoice with a specific condition that if you don't find the product satisfying, you have the right to return it within a week's time. They make it very clear. So until that 1 week is passed on, they cannot recognize the revenue because there is an element of possibility of returning the goods. So they are not supposed to recognize the revenue. That is only after the recipient receives and gives a specific approval that it has been accepted and it is not returnable, it need not be considered as revenue. Cash on delivery sales. Once again, wherever there are cash on delivery sales, the product is given and cash is received. Until then, the revenue cannot be recognized. What are the classic examples for this? Whenever dispatches are done from outstation places, whenever the dispatch is done from outstation places, VPP, I'm talking about VPP sales. All of you would have definitely had an opportunity of getting Reader's Digest a bunch of items by sending by VPP. If you don't want it, you reject it. They cannot recognize the revenue until, in respect of VPP cases, until the payment is made, it is not eligible for recognition of revenue. Same way in case of Swiggy products also. You order for something in Swiggy, it is not reaching you in time. If it is not reaching in time, you have the right to return it. The other person who is supplying that can recognize the revenue only when the cash is received by them. These are all simple examples for me to understand. But when you want to go for a larger organization, you can say very clearly there are lots of products which are being supplied. Only on approval it will be recognized as revenue, even though the risk and control gets transferred. What I was telling in the initial stages, once the risk and control is getting transferred, revenue has to be recognized. But there is an exception. Whenever a sale is being subject to conditions, only when the condition is getting completed, then only it can be considered as revenue. In respect of import and export transactions, all these things will happen until the product is installed to the satisfaction of the buyer. It cannot be recognized as a revenue. So I have mentioned about 3 conditions. One is delivery subject to acceptance. Another is delivery subject to installations and acceptance, and also delivery which is on sales. Unless otherwise delivery is made out of sales and money is not realized, it cannot be considered as revenue. This item number A will not be applicable in other cases. Item B will not be applicable in A and C. Each and everything is independent concepts per se. And the next issue is in respect of trade discount on volume sales. See, whenever I do a sales of 1 lakh for a particular person, I give a bonus to him that if you do sales to the extent of 5 lakhs in this particular week, there will be a rebate which will be given. That is a trade discount. In that situations, when this happens in respect of pharma products, basically it will happen in case of pharma products and also in case of FMCG products. So whenever the distributor has an eligibility of getting discount on the basis of volume rebates, in that situation, the revenue can be done. The revenue itself will be reduced. It will not be basically for example, I am doing a sale of 1 lakh today, 1 lakh tomorrow, on 3 lakhs day after tomorrow. Once he reaches 5 lakhs of revenue before this particular week, he is eligible for a 10% discount. In respect of those cases, I have to recognize the revenue only to the extra 4,50,000 rupees, and it will not be considered as a discount separately. I have the authority to reduce it from the revenue itself, that because the transaction is complete by the time I complete the audit, etc. It can be considered and it has to be reduced from the revenue itself. It should not be treated separately. This is in respect of trade discounts on volume sales. One more important issue is in respect of sales with warranty extended. What do you mean by extended? Each and every capital good is along with the warranty. All of us know that each and every capital good which is being supplied, let it be computer, let it be machinery, let it be laptop, let it be phone, whatever it is served along with the warranty. So the invoice will not talk anything about warranty amount. This invoice will say that this computer is worth around 25,000 rupees. I raise a bill on you. That's all. But you are given a warranty for one particular year. Let it be 1 year or 2 years as the case may be. We will not be able to segregate this particular warranty element from the sales. But as far as India is concerned, for a moment I am deviating from this. In the India what they say is there is an element of warranty element in that you should not recognize as a revenue. But as far as AS9 is concerned, when the warranty and this is inseparable, you can recognize the entire revenue. But when you have an extended warranty, what do you mean by extended warranty? For a moment, let us take a case of a car. When the car is being purchased for an amount of 20 lakhs, there is an extended warranty which is being given as a benefit to the person, and say that if you pay 60,000 rupees additionally, sir, you will be getting an extended warranty. Basic warranty is for 2 years, and there is an extended warranty for another 2 years, for which the amount is quantified. So in that situation, even though the invoice consists of the sale value of the car and also the extended warranty amount, the extended warranty amount should not be recognized as revenue. The reason being that a warranty itself is coming to effect only after the expiry of the initial warranty period. So unless the initial warranty period is crossed, that element itself will not be recognizable as income. So wherever there is an extended warranty or the warranty element is specifically identified, those items cannot be recognized along with the sale value. It has to be deferred for a moment and then it has to be calculated according to the respective years. The other option which is obviously available is in respect of warranty claims, warranty related income, we can have a separate account creating warranty income, and that kept as a liability, and from that we keep on reducing, bringing it to our account. For example, I have got some amount by way of warranty for an amount of 20,000 rupees in respect of next 2 years. So this year now our income will be recognized. Next year I will be recognizing a period of, say for example, if it is on January, I will be recognizing a period of 3 months warranty period. How the amount is going to be computed is a different calculation altogether. That depends on the company to company, policy to policy. But the point is, it is for a specific period. If it is going to be for a period of 2 years extended warranty, I have to recognize 3 months in this year, and next year 12 months, and next year 9 months, depending upon the period for which the warranty is being extended. That's so revenue should not be recognized along with, even though it is part of the sales invoice, I'm not supposed to recognize the revenue in this year itself, wherever this extended warranty is happening. I'm sure that all of you are convinced on this particular matter, but if you have any specific questions, you can mention this at a later point of time. This will be applicable in respect, that is warranty matter is applicable in respect of all the capital goods. So the revenue itself will be recognized at the, I can also tell a classic example of infrastructure projects wherein 10% of the amount will be retained as caution deposit, and they will make it very clear this 10% will be returned only after 5 years of the project successfully completed. After that only the revenue itself will be recognized. For example, I have a I can say, take the case of a desalination plant, which are long-term projects. They will have to have desalination project which is worth around 50 crores of money which is being given. 5 crores will be retained by the purchaser. The contract itself will make it very clear that 5 crores is not to be paid until it performs for 5 years. In that situation, that 5 crores need not be recognized as a revenue. It is sufficient for me to recognize the revenue as 45 crores, and 5 crores will be retained as caution money, which will be recognized only at the end of the 5th year. Until then, the revenue need not be recognized. It is not like that 50 crores has to be recognized and 5 crores has to be written off at that point of time. No, I have to recognize only to the extra 45 crores, and 5 crores will be deferred to the particular year depending upon the contract. The contract is critical. If the contract is saying otherwise, it has to be recognized accordingly. Next is installation fees. In case where installation fees are other than incidental for the sale of a product, they should recognize revenue only when the equipment is installed. That is, sale value is 1 lakh, which includes installation. In that situation, there is no revenue to be recognized separately. But the sale value is 1 lakh, and another 10,000 rupees will be paid separately as installation charges. The 10,000 will be recognized only when the installation happens, and 1 lakh will be recognized at the time of transferring the risk and reward itself. It will be recognized. They are depending upon the contracts once again. I think this I have already told. Sales with warranty extended. I don't know why it is coming for the second time. Yeah. Even though India is not part of the talk today, I would like to mention only 2 items for us to understand what is the significance of AS9. There, it has to be measured on fair value of the consideration received. So wherever the revenue has to be recognized only after 3 years, I have to discount it and hide it with what is the fair value which is receivable. In the case of sale of services, revenue associated shall be recognized only at the stage of completion of the contract. There also, the stage of completion will come into the picture. It will not be recognized in toto immediately. As far as interest is concerned, it will be a concept called effective interest method, as set out in India AS 39. We will have to go to the India AS 39, compute what is effective interest contract. Effective interest contract is explained in the next slide, at which the discounts estimated for future. For example, if I have taken a loan for 5 years, I have to calculate for the entire 5 years, discount it for the entire 5 years, and I have to recognize. It's slightly complicated exercise. I'm not going into that in detail because that is not my subject today. But I want all of you to understand that what is revenue as per AS9 will not be the same in India AS 18. That we'll have to examine, understood very clearly. So wherever your organization is going to have an India AS calculation, don't presume that AS9 itself will be sufficient. You have to go to the India AS for the purpose of computing the fair value measurement. Now let us go into certain inappropriate disclosures, because this is where we always commit mistakes. These are all standard items which has been picked up from few accounts. Revenue is recognized on accrual basis, except in the case of interest, which is accounted on cash basis. If we have given a policy like this, or if we have given the revenue, all of us have to give as per accounting standard what are our policies. If you have given this, this is wrong disclosure. Revenue cannot be recognized on accrual basis of accounting is method of accounting. Obviously, any corporate, they have to do only accrual basis. If it is not accrual basis, it is not going to have a true and fair view. So revenue is recognized on accrual basis of no relevance. Revenue has to be recognized, as I told you already, on the date of a particular functioning happen, whether it is dispatch of goods, risk and rewards getting transferred, and control is being shifted to the buyer. On that time, I have to do that. We have to mention about the timing and also the event which is happening. Revenue from sale of goods is recognized on billing. This is not right. This is not a correct disclosure at all, because invoicing can happen by any time. Invoicing has to be accepted by the other person as by way of the terms of contract. So revenue from sale of goods is not to be recognized only on billing. That is, just making a billing is not sufficient. It has to be accepted by the other person, and the risk and reward has to be transferred to the buyer. Then only it can be happening. I am giving few illustrative disclosures from the printed accounts. Revenue from sale of products is recognized when risk and rewards of ownership of the products are passed on to the customers, which is generally on dispatch of goods. Sales excludes trade discounts and rebate. Sales include excise duty but exclude sales tax and VAT. Of course, sales tax and VAT is the old discussion. Maybe if you have GST, it has to be substituted. It is in case of Procter and Gamble. Please understand, my dear friends, there are three important lines which is going to be considered here. Sale of products is recognized when risk and rewards are passed on to the customers. Whenever risk is transferred, it has to be done. Which is generally on dispatch of goods. In this particular company, which is generally on dispatch of goods. There might be some transactions which is not on dispatch of goods, only on the basis of acceptance of the goods. There is a possibility. So that is why they are mentioning us, which is generally on dispatch of goods. Wherever it is on acceptance of goods, then it will come into that picture. Second portion is sales excludes trade discounts and rebate. Obviously, this they are referring to an example which I was mentioning to you. Wherever volume discounts are there, that trade discount has to be reduced from the income recognition. So it should not be treated as a separate discount. Cash discount is different, my dear friends. That should not be part of it. It's only trade discount which will be coming here. Next is Sundaram brake lining. Interest income is recognized on a time proportion basis. This is what I was mentioning about other income. Interest income is recognized on time proportion basis. If you mention that interest income is accounted on accrual basis, which is wrong. We have to mention very clearly that interest income is recognized on time proportion basis. Insurance claims are recognized on certainty of realization. Certainty of realization is coming to the picture. I was mentioning about the earlier recognition, where there is no certainty or where there is an element of uncertainty, we don't have to recognize the revenue. What happens is, in case of a fire accident, I will share you with a classic example of an organization. There was a fire accident. There was a loss to the extent of 1.2 crores by way of raw materials damages. In that case, they have made an insurance claim. Insurance claim was not accepted. It was stretched beyond a audit period. So when we wanted to recognize the cost, we have adjusted the cost. But that insurance claim, which they were expecting, we did not recognize the revenue until it was received. The reason being, even after the insurance company gave an amount of claim which has been accepted, we did not recognize the revenue because the client went for an appeal. Because this they have claimed an amount of 1.2 crores, only 25 lakhs was given. They went on appeal. So we are not sure that 25 lakhs itself is to be recognized as revenue. The 25 lakhs can go up, can go down in the appellate forum. So it did not be disclosed. So insurance claim need not be recognized until there is a certainty of realization. This is what Sundaram brake lining has suggested, which is right disclosure. Another company, once again, sorry, my computer is losing power. Revenue from contracts priced on a time and material basis are recognized when services are rendered and related costs are incurred. It's absolute prudence of accounting that whenever a revenue is recognized, a matching cost has to be recognized. So in respect of revenue from contracts, it is priced on a time and material basis. services are rendered and related costs are incurred. At that time, revenue is recognized. In case of a turnkey contracts, which are generally time-bound fixed price contracts, are recognized over the life of the contract using the proportionate completion method, which is what I was explaining in the initial stages. It is in respect of a service company. I am giving examples of production company, service company, and other incomes also, with the contract cost determining the degree of completion. So each and every degree, for example, 60% of the degree or basement completed, like that, everything is there. This is the software company, Tata Consulting Services. Revenue from sale of software licenses are recognized upon delivery. Revenue from maintenance contracts are recognized pro rata over the period of the contract. Same software company, they have two product lines. One is software licenses. So as far as software licenses are concerned, it is recognized upon delivery because that is the contract. I deliver the product, it is accepted. That's all. There beyond that, for example, all of us will be buying Microsoft licenses. Once the license comes, it is it has to be recognized as far as they are concerned. In the same way, in case of maintenance contract, it has to be pro rata over a period of contract because it is not for one-time payment. It is for a period of 1 year or 2 years, as the case may be. So it has to be done according to the period of contract. I have covered AS9. 1 hour is completed. I would like to have any questions are there on the mailbox.
One question.
The question is for real estate, both AS7 and AS9 would apply. Please explain in brief for revenue recognition. It's a good, very good, fantastic question. As far as I'm just taking from the same examples which I have given to you, whenever a flat is being constructed, I have to do the, I'm taking a flat construction because I always consider these lectures are for SMEs and SMPs, not for large practitioners, because large practitioners have their own mechanism. So I'm talking about a normal course of construction which will happen. So whenever I'm talking auditing a company which is doing in construction of flats and keeping it, the timing of revenue recognition is at the time of entering into a contract of agreement of sale, and once the undivided share of land is being sold and construction agreement is entered into. I will take a classic example because the questioner has asked for a specific explanation. AS7 is the methodology. There is no second thought at all. AS7 is the methodology because once a flat is there for an amount of 50 lakhs, say for example, I will understand, I will take the case of a flat of 1000 square feet of building, 1000 square feet of flat, 550 lakhs is the value of the flat, which consists of 10 lakhs to the extent of undivided share of land and 40 lakhs towards the construction value. This 10 lakhs of undivided share of land will be recognized on execution of the land sale deed and registered with the registrar. So the timing of recognition of revenue in respect of the UDS is at the time of registration of the undivided share of land and land is being transferred at the sub-registrar office. That is the timing. At that time, I will have to recognize the revenue. No AS7. It is only AS9. As far as construction portion is concerned, say for example, in case of 40 lakhs of revenue in respect of the construction size, that will be recognized on the basis of agreement between the builder and the developer and the buyer of the property. That is on the basis of basement completion, 10%, on the basis of first floor completion, 30%, on the basis of second floor, 70%, on the basis of handing over 90 completion of top floor, 90%, on the basis of handing over 100%. There will be a contract will be part of the construction agreement. So on that basis, I have to recognize the revenue. Once again, whether the building has been constructed according to that has to be estimated by way of independent valuer who will be part of the architect or valuer which will be involved in the company. They have to estimate whether that construction at the end of the year has been up to that particular stage. In that situation, I have to recognize the revenue. For a moment, I will take the example once again. 40 lakhs is the construction cost. At the first year level, 25% of the amount has to be recognized according to the terms. In that situation, I have to recognize 10 lakhs as the revenue. I might have received 20 lakhs from the flat buyer or even 5 lakhs from the buyer. That does not have any relevance. What is received is of no relevance. What is the percentage to be completed? The percentage of completion can be recognized on two. I'm getting diverted into AS7 for a moment because the question has been asked specifically. The percentage of completion can be determined on two methodology as far as AS7 is concerned. One is on the basis of the expenditure incurred on the project vis-a-vis the total expenditure which is projected. For this particular project, if my total cost which is recognized to the which is estimated is 2 crores and I have incurred 20 lakhs, 10% is covered, 10% is completed. That is the AS7 gives us the option. The other time is I can do an estimate of the construction. So much of building that 50,000 square feet has to be constructed with a basement, first floor, second floor, third floor. There can be an independent estimate by an architect. On that basis, I can complete. By whatever method you complete that, you have to determine that revenue. What is the amount which is received from the flat buyer is of no relevance. I have to estimate. If I have collected 5 lakhs, but 10 lakhs has to be recognized, I have to recognize 10 lakhs as revenue and 5 lakhs has to be shown as receivable. If I have collected 15 lakhs and only 10 lakhs has to be recognized, balance 5 lakhs has to be kept as advance received from the buyer. I hope I have clarified the issue as far as this question is concerned. If you have any further question, you can ask. When will we consider the fair value and how we calculate the fair value? Once again, this is an Ind AS question. I don't want to come into this Ind AS question because if it goes there, determination of fair value itself is a huge exercise. I don't want to go into this picture. When we take a class on Ind AS, we can look at that. When risk and rewards were transferred invoices, when risk is, I think it's a question. The company became insolvent before the balance sheet date. The revenue need not be recognized. Is it in consonance with GST Act? What about annual maintenance contract? See, what has happened is this income tax, GST, and companies act, all the three has to speak the same word, same language, which doesn't happen. But when ultimately when it is to be recognized, once again, for a moment, I have to divert into GST Act. When I have recognized the revenue in the month of March, I raised an invoice, risk is transferred, I raise an invoice, I recognize the revenue also. Accordingly, GST also calculated and remitted. But I always have an option in, I think it is Form 9 and 9C, if I'm right, because I'm not too good in GST. Form 9 and 9C, when I do the Form 9 and 9C, if I have decided that this revenue need not be recognized and reverse that entry by events occurring after the date of balance sheet date, I can revise the same figures in Form 9 and 9C. Otherwise, the same item can be reversed in GST subsequent year. For as far as books of accounts is concerned, I have to recognize income only to the extent of not decided as not recoverable or insolvent become before the balance sheet. I don't have to recognize the revenue. It is not in consonance with GST Act because GST Act it says that revenue will be recognized on the dispatch of goods and raising of an invoice. But as far as the revenue recognition norms is concerned, it will be considered only if it is fully recoverable. If it is not recoverable, I don't have to recognize the revenue. For all practical purposes, in case of an insolvency cases, I would have definitely raised an invoice and recognized the revenue also. Only during the audit, I de-recognize the revenue. Because we are de-recognizing the revenue for the purpose of Companies Act, in GST also, I have to de-recognize. I have to go through the Form 9 and 9C process. What about annual maintenance contract? I don't think annual maintenance contract is referred to insolvency once again. If it is insolvency, annual maintenance contract, normally money is received well in advance. Only it is being proportionately allocated to income. Money is received in advance. No AMC is done without receiving the money in advance. So the money is received in advance. There is no complication as far as insolvency is concerned. But if your question is separately for annual maintenance contract, I make it very, very clear. As it was mentioned in the Tata Consultancy Services balance sheet, annual maintenance contracts will be recognized as revenue on the period of contract. If 3 months period is over in this year, I will have to recognize only to the extent of 3 months, and balance 9 months will be deferred to the next year. If you have covered 6 months in this year, I have to recognize to the extent of 6 months, and balance will be deferred to the next year.
Those were the questions, sir. So we'll go with the presentation. Okay, given you the right, sir, you can just click on show my screen. Yes, visible, sir.
Thank you, my dear friends, for putting only 3 questions. Either all of you have understood fully or you have not understood anything at all. Either way, I prefer the first answer. All of you have understood fully. So I will go ahead with the AS 15. If you have any further queries, once again, I assure you, my friends, I have given my mail ID in the last slide. The slide will be distributed to all of you by the organizers. You can go through and raise the question. I will be able to respond as early as possible. The second portion of this presentation is on AS9. I'm sorry, AS15, which is the employee benefits. I would like to make it very, very clear. This AS15 is all of us know what is employee benefits, but only thing is being structured in a proper format to ensure that all of us are forming the uniform methodology in accounting these standards. So once again, coverage, I have applicability, objectives are the accounting standards. What are the types of employee benefits which is going to be discussed in this presentation? How do you recognize and measurement, and how do you disclose? Once again, after the disclosure requirement, illustrative disclosures. This is how I have structured the program, so that another 40 minutes I will be able to cover this AS15. AS15, unfortunately, less practical and more theoretical. Unlike AS9, we have lots of sample studies which are available in that. AS15 is not like that. But anyway, we have to discuss about this. We'll go through the particular portion. It is applicable to all enterprises. 1, 2, 3, all of them it will be applicable. And obviously, it will be applicable to all corporates except India, where India is available. But of course, there is a relaxation given for level 2 and level 3. What are the relaxations which has been given? For SNC, small and medium companies and entities in level 2 and 3, discounting is not required when the for contribution fall beyond 12 months. For a moment, you retain this. When I come to this beyond 12 months, etc., I will talk about the discounting once again. Normally, for SNCs and entities in level 2 and 3, discounting is not required. Whereas in case of level 1 companies and large companies, discounting has to be happening. For non-corporate entities in level 2 and 3, for long-term benefits, any other rational method can be used. What do you mean by any other rational method? Only when we understand the first method, we can talk about any other rational method. Once again, the first method, I will come to that. All of you know about this, but still, for a moment of suspense, let us retain it. At that time, we'll go. For a moment, let us understand that this AS15 is applicable for all enterprises, 1, 2, and 3. It is applicable in respect of all corporates except for those applicable for India AS. But there is a relaxation given for SMCs and level 2 and level 3 organizations. Of course, in the disclosure also, there are some benefits which is being given, can be go through the system. What is the objective? Once again, as we discussed in AS9, it is for prescribing, accounting, and disclosure. This is the way it has to be accounted. Because one person talks about employee benefit in a different manner, the other company informs in a different manner, there will not be any uniformity at all. To recognize the liability in respect of employees for payment in future. What is signed on a financial year 31st of March 2021, and what is liability for the future when a student, when an employee continues for another 5 years or 10 years or 20 years, what is liable to be paid at that point of time also has to be recognized now itself. To recognize the expenses towards consumption of services. What is basically an employee benefit? When an employee is there with you, I am utilizing his services, I am utilizing his time, I am utilizing his manpower. When I am utilizing, I am getting the benefit from the employee. Employee has to be, I have to recognize certain items. That is what is my cost as far as the AS15 is concerned. So consumption of services provided by employees, I utilize it during their services. What do you mean by during their services? Whenever they are doing that, immediately I have to pay by way of salary, by way of medical expenses, by way of insurance, etc. So there are two items. One is a liability which is going to be spent after he retires or after he goes out. Another is when he is in service itself. So for doing this, the accounting standard makes it very clear. This is the way it has to be accounted. There are few types of benefits. One is short-term employee benefits falling due wholly within 12 months. The entire item which has to be paid within 12 months. What is example? All of us know salary, bonus, incentives, which are all paid within this 1 month. Even the PF contribution comes under this short-term employment benefit. So anything which is within the 12 months, will come under short-term employee benefits. Other long-term employee benefits not falling wholly within 12 months. What are all the examples? Retainership bonus. What happens is whenever an employee is there, as on 31st of March 2021, when I am signing the balance sheet, if the employer continues for the service for one more year, for that up to 31/3/2022, if he is there, in 2022-23, that retention bonus will be given. Bonus, there are two types of bonus. One is performance bonus, statutory bonus, which is 8.33%, which is normally understood, or 20% if it is including ex gratia. This bonus is different from the retention bonus. Retention bonus is long-term employee benefit. If he survives for another 1 year, after the 1 year is completed, that retainer bonus will be given. This is one more example. Another example of this long-term benefit is leave encashment. The leave encashment is not given immediately. The leave encashment is given after a period of specific, say for example, 5 years, 10 years, or at the time of retirement. So this is long-term. I'm telling with examples for you to understand in a better manner. The third benefit is post-employment benefit. Only after he completes the employment, he will be eligible for that. Example, gratuity, PF unencashed, leave encashment, or accumulated bonuses, superannuation fund. All these things are coming under post-employment benefit. These will be given only after he retires. Until he retires, this money will not be given, either retirements or retrenchment. The last one is termination benefits. Termination benefits is by way of either voluntary retirement or retrenchment or dismissal, as the case may be, in case there is a dismissal also. This is termination. These are the only 4 types of employee benefits which our accounting standard contemplates. Short-term employee benefits, which is payable within 12 months by way of nature of salary, medical claim insurance, medical expenses reimbursed, leave travel concession. That is when they go for a holiday, that leave travel concessions, HRA, all these things come under short-term employee benefits. Long-term employee benefits is what is going to be paid after 12 months. Post-employment benefits after retirement. And termination is whenever the organization sends the people out in premature basis. How do you recognize and measure? Short-term, this is what is standard saying, sir. All of us know how it is being recognized. Salary is recognized on what basis? As per the contractual term, monthly salary is 15,000 rupees. You recognize 15,000 rupees. But the standard says, recognize the entire expenditure for the benefits rendered undiscounted. This is what we normally do. But the standard gives you a categorical computation saying that account it on undiscounted basis. Provide for the liability to the extent not paid. All of us are providing as outstanding liabilities. This is what is exactly mentioned in the standard also. For 31st of March, when we finalize the accounts, up to February, you would have paid the salary. March, you are providing by way of outstanding liabilities. That's all they are mentioning. Provide for liability to the extent not paid. I am telling a class standard example, but there might be some corporates who might not be having sufficient fund. January, February itself, they would not have paid. Even in that cases, I have to provide for it. Nothing, no discounting, nothing. It has to be provided undiscounted basis. Short-term compensations, salaries, wages, short-term compensations, perquisites. What are the perquisites? Maybe an HRA will be provided, or unfurnished accommodation may be provided. A vehicle may be provided to them. Mediclaim may be paid to the people. Medical expenses reimbursement will be possible. All these things are short-term employee benefits. So whatever be the benefits rendered by the employee, to the extent you have to recognize the entire expenditure undiscounted. No discounting is required. Provide for liability to the extent not paid. Fortunately, there is no requirement of actuary, etc., which will come in the subsequent item. So there is no estimates which are required. As per the contractual terms of the employee-employer, all these things has to be provided for. Other long-term benefits. Examples are leave encashment, long-term service, share-based payments. I hope all of you know about share-based payments. That is basically a rights given, ESOPs given, options given for purchase of shares of the company. Long service means for every 5 years of service which is being done, you will be given a bonus, additional bonus to the extent of 25,000 rupees or 1 lakh, or as the case may be. So in those cases, there is an actuarial estimate required. I cannot do the, I am not expertise in this area, so I will not be doing the estimate. There will be an actuary who will be estimating that on the basis of the company's database which is being given, how much is the leave encashment for every, that is, as on date, he has so much of unearned leave. For the next so many years of service, he may be calculating so much of leave encashment will be available. That will be discounted on the basis of a specific discount rate, as well as this actuary will be estimating that. Also, they will be calculating what is the attrition on the basis of the past experience. That also they will calculate. What is the increment which is normally given by the organization? That increment also will be calculated on that basis. It's a science. Actuarial is a separate science which I don't understand. I don't know anybody else in the chartered profession also understands in a reasonable manner. But let us not understand that. Let us understand for a moment that the actuarial is a separate science. Actuary is a person who is equipped in that. He will do the estimate, and on that basis of estimate, I have to recognize the liability on the present value of the obligation. What is the present value of the obligation? Present value of the obligation is, if in my organization I have an ex-employee, that ex-employee will do the entire service for a period of 60 up to the age of 60 years. If he serves the entire 60 years, he will be eligible for an element of so much as leave encashment. Because he is in the 50th year, another 5 years he will be eligible for a long-term service bonus. That I will discount. Share-based payment, he will be eligible for an ESOP after a period of 2 years. I will have to compute, and that also I will have to calculate it here. So, what is the obligation which is going to be paid over a period of next 10 years? I will calculate. I will discount it to the present value. On the present value of obligation, I will have to provide for it. Even though it is slightly theoretical and is not understandable, for a moment, let us understand. If Sundararajan is going to retire from this company, he will be getting an amount of 10 lakhs at the end of 2026 or 2036, as the case may be. I have to discount it by a specific rate. Let us not complicate this beyond a level, because actuary is equipped for that. There is a science for that. They will be computing that. On the basis of that, I have to determine the liability of the present value of the obligation, that I have to provide for it. And expenses, I have to account to the extent of increase in the present value of obligation. What was the present value of obligation as on 31st of March 2020? What is the present value of obligation as on 31st of March 2021? The difference I have to provide for it after adjusting the interest on plan asset. Now I have to understand what is the plan asset. The organization has the ability or ability to pay at any point of time. Then they don't have to go for plan asset, etc. But all the reputed organization go for a plan asset, because they don't want to take the risk of huge liability falling at their head at a later date. So they go for a plan asset. So each and every year they compute what is the liability. Let it be 2 lakhs, 3 lakhs, 4 lakhs, as the case may be. They keep on putting into a plan asset. The plan assets are being maintained by organizations like LIC, Bajaj, various people are there. Even the government is having that. So they will provide for that plan asset, and that plan asset will be invested in various investments. There will be an interest which will be accumulated from that. That interest also I can claim it, because that interest is obviously part of the amount which is liable available for distribution to the employees. So we have to compute that plan asset. There might be an actual gain or losses also. Every year when they do the re-estimate, the actual gain or loss, what is that actual line? For a moment, let us understand that. Today, I say that attrition rate is 8% in the organization. Next year, when you do that, the attrition may be reduced or may be increased. In that situation, there may be an actual gain or loss. Same way, increment. Last 2 years, most of the organization has not given any increment at all. But when I computed that provision for 31st of March 2020, I would have calculated that there will be an increment of 10% every year. Next 2 years, there is no increment at all. So there will be an element of actual gain or loss which may happen in any of those items. So whenever there is an actual gain or loss, and also there is an interest which is in respect of plan asset, or the plan asset, if it is going to be a mutual fund, there might be a net NAV increase will be there. NAV decrease will be there. To compensate that, we have to provide for recognition of expenses to the extent of what was the present value obligation of the opening date, what is the present value obligation at the end of the date, difference I have to provide for it. For a moment, I will once again repeat to the friends, you don't have to complicate this. Just understand an actuary is there who is going to be a scientific person. I have SA 620 to depend on that. He's an auditor's expert. 620 is in respect of auditing standards, where I can rely on the auditor's expert. There are 2 experts which are available. SA 500 on management expert, SA 620 on auditors expert. He is considered an auditors expert. Only thing what we'll have to understand is, I will be bringing one more slide in the case of issue, but I am repeating here also. What is the input which is given for the actuary, whether it is right, which has to be examined by us. Whether the actuary has assumed reasonable rate of discounting, which we have to examine. Whether he has identified the reasonable amount of attrition rate, we have to examine. Whether he has considered the reasonable amount of increment rate, which has to be examined. Whether he has taken the correct date. I will share you a classic example. In one particular organization, all the computation has been done till 31st of March 2020 as 60 years as the retirement date. What has happened is, as the government policy has changed last year, they have reduced the retirement date as 58. Obviously, the actuary has to be informed that there is a policy change, the date is being shifted to 58. Obviously, there will be a huge change in the actuary. In that particular company, that was not intimated to the actuary. Actuary has calculated on the basis of 61. It's a state government undertaking. It has happened. I'm not talking from sky. It was an actual action which has happened in case of a governmental undertaking. Actuary has valued at 60 years of age. He has not been given that input. When we did the audit, we asked, sir, there is a change in this, why it has not been done. So we had to revise the entire financial statements. We asked for the actuary to do the revised calculation. On that basis, we could calculate at the age of 58. So don't presume. When I told you in the first stage, we don't have to worry about this science because it is somebody else's expertise domain. But at the same time, what is the information provided to them and what is the assumptions she has done, we have to find it. Because SA 620 makes it very, very clear. You can depend on the expert's information, provided there is a reasonableness of all these assumptions are examined by you. Only then you can accept it. Please understand, SA 620 will save you for the purpose of determining the quantum of recognition by way of liability, also the expenses. But we have to estimate, we have to examine whether they have done the estimates in a proper manner. Hope I am very clear about this. Third item is post-employment benefits, as I told you, gratuity, provident fund, pension, etc. I don't have to explain to you what is gratuity, PF, pension, etc. All of us understand that. But only one thing which I want to understand is there are 2 plans which are possible. One is defined contribution plan, and another is defined benefit plan. I have seen through lots of reports as well as auditors are concerned in case of SMEs. They are not aware of what is defined contribution plan and defined benefit plan itself. In case of a defined contribution plan, entity liability is getting restricted to amount of contribution. Standard examples is PF and National Pension Scheme. If I don't have a pension scheme, I am contributing to National Pension Scheme. My liability is restricted to the contribution. For example, if I'm going to contribute 10% of salary basic pay as PF, with that my responsibility is over. That is, for example, a person is drawing a salary of 10,000 rupees. I am restricting my contribution to 1,000 rupees. If it goes beyond 2,000 rupees, I am contributing to the extra 1,800 rupees only. Beyond that, I don't have to contribute. The employee can contribute anything. I'm not concerned. As far as the employer's contribution is concerned, it is restricted to 1,800 rupees. So here it is defined contribution plan. So wherever a defined contribution plan is there, my liability is restricted to agreed upon contribution. Let it be PF, let it be NPS, or as the case may be. In that case, I have to recognize the quantum of short-term benefit from the employee and contributed. Whatever I have contributed, I have to recognize the quantum of that. With that, it's over. Wherever there is a payment outstanding, to that extent, I have to create a liability. That is, month on month, whatever I am contributing to the PF, I have to recognize an expenditure. Whenever there is a short contribution, probably the last month I have not paid or the earlier months I have not paid, to that extent, as reduced by payment, I have to provide for the contribution payable. What do you do in case of defined benefit plan? In respect of defined benefit plan, I am responsible for making the entire payment. Exact example is gratuity. In respect of gratuity, there is a benefit which is going to be achieved, which is going to be allocated to the staff after 15 years, or as the case may be. Same way in case of leave encashment also. There are two possibilities depending upon the respective employers. There are certain employees which say that there is no leave encashment at all. You have to utilize the leave in this particular month itself and get away with that. You are not eligible for leave encashment. There is another organization which will say that you can accumulate cash up subject to a maximum of total 20 days for the whole service. You can claim, you will be eligible for that. That is a every possibility, depending upon the respective company's contract. But the point which you want to take home is there is a benefit which is going to be bestowed on the employee after a specific period. So every year I have to make a contribution, and the contribution gets accumulated beyond a level. That money is being placed in a particular methodology by way of an investment. There is actuarial gain, there is an actuarial loss, there is an interest income, there is a fund value increase. All these things has to be recognized, and I have to provide for every year. What was the obligation last year? What is the obligation this year? Difference I have to provide. What was the liability last year? What is the liability this year? I have to provide for, and it has to be fair value has to be ascertained. That is each and every plan asset. I have to determine the fair value as on 31st of March of every year, and on that basis I have to provide. Without actual valuation, I cannot do this at all. Once again, as I told you, what do you mean by actual valuation? It's a scientific method of computing what is my future value of obligation after 15 years, 20 years, or 30 years, as the case may be. I have to discount it and I have to provide for that. On that basis, I have to recognize the liability as well as I have to recognize the expenditure. As far as this termination benefit is concerned, voluntary retirement or retrenchment compensation, or even the case of dismissal. So in those cases, I have to recognize the liability only when there is a formal plan of termination is approved. There should be an approved plan. In case of VRS scheme, bulk VRS scheme, they always get an approval. Once an approval is there, according to that, I have to make a provision. And when there is a reliable estimate also happens. Without doing an estimate, I cannot make a provision at all. So reliable estimate is there. And what is going to be the outflow for which I am eligible for liable for obligation, to the extent I have to provide. What is the amount to be claimed as expenditure? What is claimed as expenditure will be provided for. This is not going to be a long term. Termination benefit is not going to happen after 10 years. Once I have decided to terminate a group of persons this year, next year they will be definitely terminated. For example, today I take a call that any employee who are provided for services more than 25 years and across 55 years are eligible for offering for VRS, because I want to churn my manpower. So I do the termination. I give a scheme. I will determine that scheme and I will have to provide for the liability. So I need to have a formal plan. I need to have an estimate, and I have to determine where from I am going to make the payment. Once that is there, I have to provide for it. If these items are not there, I don't have to provide for it. This is in respect of voluntary retirement by way of a scheme or a retrenchment by way of a scheme. Same way, if I'm going to dismiss an employee, I'm going to terminate an employee because of either non-performance or for any other reason for that matter. So I'm doing it on the month of March. I have to compute what is the liability for him. I have to make a provision on 31st of March so that the money will be paid in the next year. So there are 4 types of benefits: short-term benefits, long-term benefits, post-employment benefits, and termination benefits. This is the way I have to do the measurement. I have given this computation. What are the issues which will happen? First, non-corporates. As far as non-corporates are concerned, please understand, my dear friends, AS 15 is applicable in respect of non-corporates also. But none of the partnership firms or trusts which are doing the audit, they will not be doing any of these compliances at all. So you have 2 options. One is report AS 15 has not been followed. You also have to mention that it is not able to be quantified, so you don't quantify also, but you qualify in the main report. Where do you qualify? Form 3CA, wherever tax audit is applicable, where you give a special purpose report, in that you can qualify. Because most of the non-corporates do not contribute anything towards gratuity or towards leave encashment, etc. Because they say that we don't have a policy. They are not under compulsion to do a policy like that. But as far as chartered accounts are concerned, we are bound by ICAI, so we have to make a qualification or make a report accordingly. Wherever corporates are concerned, what is the issue? Once again, As far as gratuity is concerned, anyway, more than 20% of the more than 10% of the employees there only gratuity will be applicable. So non-corporate, when there is a less than 10%, you don't have to bother. There is no issue. I'm not coming into that area. What is the number of employees, etc., which has to be considered separately. As far as corporates are concerned, normally I have seen lot of reports wherein saying that company has been incorporated only in 2020, so no provision for gratuity is done, which is wrong, because company is created as a permanent entity. It's an artificial person. It will go on forever. In that situation, going concern concept, the company is expected to live beyond 5 years. So once a company is created, from the day one, gratuity liability is started. Leave encashment liability is started right from the first day. So it's a wrong assumption that only after 5 years I am eligible for gratuity. The employees are eligible for gratuity only after 5 years. But the company is liable for gratuity on the first day onwards. Please understand, this is a serious issue. I have gone through lots of reports which people say that in case of private limited company, gratuity act is not applicable to us. It's not the case, except that number of employees. When the number of employees is less than 10, probably you may be escaping, no liability is there. Corporates, one more item, which is gratuity is accounted on cash basis. We leave it like that, which is wrong. Once you say it is cash basis, obviously the company's accounts itself is not showing a true and fair view. You are bound to qualify, and also you are bound to quantify. For quantification, once again, you have to go to actuarial valuation. Actuarial valuation, they will not be inclined to give it to you in case of private limited companies. They will say that I will not do it. In that situation, you have to qualify and say that the quantification is not possible for various reasons. You have to mention that. But without that, the organization's financial statements is not complete. So AS 15 is very, very clear. It has to be applied in respect of all corporates, non-corporates. But one item is, as I was telling the other stage, the discounting need not happen in case of non-corporates of level 2 and level 3 enterprises. In case of SMCs, I don't have to do the discounting. And the methodology, as I told you, any rational method we can follow. Any rational method we can follow. We don't have to go for actuarial method. You can do your own system of computing the gratuity and you can make the provision. Corporate restructuring, mergers, demergers. In these cases, whenever the employees are transferred from one organization to another organization, there is also another possibility in case of restructure. They will say that you resign from this company, you will get admitted to the other company. What will happen in respect of the gratuity component? Very, very ticklish issue. PF issue, it will be automatically transferred. There is no problem because it is coming under defined contribution plan. In case of gratuity and leave encashment, where it is a defined benefit plan, you will be having an issue. That issue has to be addressed at that point of time only. I don't have a solution straight away for that. In the actual valuation itself, lots of issues will happen. If the inputs given is not proper, right? As I told you in case of a company called 58 and 68 years of age. Methodology of valuation has to be examined. As I already explained to you, SA 620 will support you. Relying on the expert's opinion, you are eligible for relying on the expert's opinion, but provided the methodology evaluation is right. Attrition rates, increment rates are all subjective matters. We have to examine what was there as attrition in the last few years, what is going to be in the next few years. Increment rates, what was the past experience, what is the current COVID experience, what is going to be in the future. That reasonable estimate has to be there and it is justifiable. If it is not justifiable, the issues will be leading to a different problem. What is the disclosure requirement? As far as the short-term benefits are concerned, there is no problem at all. You can very well say that it is accounted on the basis of actual estimate which has been done. There is no major estimates which are required. What is the disclosure in respect of defined benefit obligation? These are all the items which are supposed to be explained, disclosed. Current service cost, interest cost, contribution by plan. All these things are available in the actuarial report. You don't have to bother. But at the same time, you have to decide what is going to be there. And the same way, general description of type of plan. There are multiple types of plan which is available. For example, I may have my own trust. For example, Sundararajan Associate, SRBR Associate LLP is there. I can have my own trust of the employees and I can contribute within myself and I can maintain the investment scheme itself. This is one option. Another option, I can go with an organization called LIC. I can go with an organization called Bajaj. I can go with any other organization, or even for the government is also having the trust for that. I can contribute that. I can collect the money, I can contribute and pay it into that account. That plan has to be explained in the general description of the type of plan. What is the plan which I am going to have? A reconciliation has to happen, because what is the expected return on plan asset? As I told you, there is a whatever be the amount which is being contributed will go into a particular asset by way of plan asset, which is maintained by any of these Bajaj, LIC, government, etc. And there are every year there will be actual gains and losses which will happen because of number of employees going out, number of employees increasing. All these things will have a conceptual involvement. And what is the contribution by the employer? How the benefits are being paid. Every year there will be retirement also. For example, as on 31st of March 2020, I might have 23 employees for which I have computed the calculation. I have provided for an amount of 23 lakhs. During the current year, three persons might have retired. I would have actually paid. I would have drawn money from the fund and I would have paid them. Now only 20 employees are there. So in respect of 20 employees, I have to once again calculate at the end of the year and decide what is the present value of obligation and I have to provide for it. So these computations are very much available. You don't have to bother about much about all these things, but only thing is SA 620 you determine, calculate and find out. Let us go into the illustrative disclosures from published accounts. There are two concepts. One is what is policy and what is computation. I will mention about the policies here, which is given in the slides. Computation, I will have a link. If it is possible, I will go through that. But it is very much available in the published accounts. Infosys. Why once again go to Infosys? They are all model standard. They have been considered as the best presented accounts over a period of time. So I have picked up that. Gratuity and pension, defined benefit plan. The company provides for a gratuity, a defined benefit retirement plan covering the eligible Indian employees of Infosys. The gratuity plan provides a lump sum payment to vested employees at the retirement, death, incapacitation, or termination of employment. There are 4 types by way of retirement of an amount based on respective employee salary and the tenure of employment of the company. The company contributes gratuity liability to Infosys liabilities, employees gratuity fund trust. In this case, Infosys Limited is having their own gratuity fund trust. The money is managed by their own trustees. Trustees basically consist of certain employees and also from the management. Trustees administer the contribution made to the trust, and contributions are invested in a scheme with the Life Insurance Corporation of India as permitted by law. Please understand, my dear friends, there are 2 components to this. One is the gratuity fund trust should have been approved by the Chief Commissioner of Income Tax or Principal Commissioner of Income Tax as the case today. It should be approved. If that gratuity fund trust is not approved by the appropriate authority, whatever be the amount you are contributing in trust is not eligible for deduction under 40A9. I am diverting myself into the Income Tax Act. Under 40A9, it will not be eligible for the tax. So the gratuity fund should be approved by the concerned authority. What happens is, many organizations I have seen, they will have a gratuity account, they will compute, they will also contribute to LIC, but the trust would not have been approved. In that situation, the amount will not be eligible for a deduction at all under 40A9. So please understand that gratuity fund amount has to be contributed by the employer, it has to go to a specific fund, and that fund has to be managed properly by the trust, and there will be actual gains and losses. This is Infosys. It is continuation actually. The liabilities with regard to these defined values are determined by an actuarial valuation performed by an independent actuary at each balance sheet day, used the projected unit cost credit method. This is a method on which they will calculate it. These defined plans expose the company to actual risk, etc. What are the risks which are available? They are mentioning them. This is a beautiful policy which has been explained by Infosys. Wherever there are defined benefit plans are there, gratuity and pensions continue. The employee recognizes the net obligation of the defined benefit plan, gains and losses through remeasurements, all these things they are mentioning. I'm going to circulate this. You can go through that independently. As far as Provident Fund is concerned, the eligible employee of Infosys receive benefits from Provident, which is a defined benefit plan. Both employee make monthly contributions. The company contributes a portion of the Infosys. Once again, employee provident fund trust is being created. They contribute to the provident fund trust. Why I have given this yellow color here? Couple of slides later, you will have to understand the reasons for this. They also have a superannuation fund. See, there are lots of retirement funds that are available. Gratuity, superannuation, pension, provident fund, all these things are lots of funds are there. What is that they are doing in respect of each and every fund? That policy has to be mentioned. These are all very, very ideal. The corpus is also maintained with Life Insurance Corporation of India. Compensated absence. What do you mean by compensated? Basically, whenever there are absences which are available, that leave of absence has to be compensated, which is being given. So please understand, whenever there are leaves which is not being utilized, that leave will be compensated by them. They are all non-accumulating nature, because every year they will be distributing the leave salary. Though this is once again a policy which is be given. All these things are policies. Wheels India Limited. Defined contribution. The same concept. Finally, they say the company contributes all the assets and liabilities to LIC, who is the administrator of the plan. This is what I said. It's yellow color. In Infosys, they have a trust, but they are giving the money to LIC, which means the custodian is LIC, but the funds are being monitored by the trust. In this case of Wheels India, the custodian is also LIC and administrator is also LIC. They are given to the LIC for managing the entire fund. This is the difference between that company and this company. Once again, provident fund, every month it is being paid as a specified percentage of eligible covered employee salary. This is what I said about 10%, 12% or 1,800 as the case may be. ITC Limited. Here, the company recognizes the contribution payable to such trust. They have approved trust. They are transferred approved trust, my dear friends. They have to get the each and every trust approved. It is not your 12A approved trust. That is not the case. It is a different trust. It has to go to the Chief Commissioner of Income Tax. Now it is called the Principal Commissioner of Income Tax. You have to go for an approval independently. These are few computation disclosures. The earlier things are policy disclosures. I have taken the 3 disclosures. Mr. I forgot who is the
Visible,
person who is author. Sir, is it seen?
Yeah, it's visible, sir. I can see the PDF. Yeah.
Okay. Here I am going to see, these are the things, gratuity and pension. This is the way it has to be determined. Benefit obligations, how the fair value is being done, how contribution is being done, all these things has to be disclosed. This will be form part of the actuarial report only. Assumptions are also given, discount rate is given, weighted average rate is given, all the attrition rate, everything is being given very clearly. This is basically a lift from actuarial report, but please understand this has to be given. Wheels India Limited, once again, these are the policies and these are the statements. What is recognized in the P&L account? Changes in defined benefit obligation, gratuity funded, opening balance, closing balance, how much is being recognized, what is the amount recognized in the profit and loss account, how much is recognized in the balance sheet. This is recognized in the balance sheet. This is recognized in the P&L account. Same way ITC Limited. I just picked a few examples for us to understand. Recognition in the statement of profit and loss account, what is the component of employers and what is being shown in the net asset liability in the balance sheet. The entire thing has to be pension, gratuity, leave encashment. Pension, gratuity, leave encashment. Previous year, current year. These are the few disclosures which has to happen. As I told you in the earlier occasions, I told about policy. Here I have told about the disclosures. I am through with my presentations. I don't think anything else is there.
Okay. So
I have given my email ready. If I have any questions, I will pick up the questions now itself. I have stuck to my time. 7 o'clock, I am supposed to close. The organizers, I think they will be happy that I am closing on time.
Yes, sir. Sir, is my screen visible? There are 2 questions.
Visible, very much. There is a very close difference between AS 15 and India AS 19 post-employment benefits. Actually, is based on the employee benefits. Actually, based. Yes, there is a close difference. Once again, as I told you, fair value measurements has to be examined. There is a small difference which has to be ascertained at that point of time. Why should we classify the exempt PFs managed by companies as benefit plans, as the liability of the employer company is clearly measurable as difference between return on plan assets and notified return. This difference arises on asset side and not liability side of the balance sheet. Also, we cannot apply project unit method. I'm not able to understand clearly his point. Probably he can send a mail. I will respond to him in detail. Basically, I'm not able to understand, because see, whenever I have an investment, see, benefit plan is there. I collect the contribution. One side it is liability. The amount directly I invest into the asset. So it is not the difference on liability alone. It is difference on asset also, because the asset keeps on increasing and decreasing in value, because the money is invested in various mutual funds or any other plans by way of debt funds. I am investing in debt funds. That amount keeps on increasing and decreasing as the market fluctuates. So there is an NAV difference which will happen. So it is my asset only which has an increase and decrease in value. Liability increase or decrease also happens because there may be an actuarial valuation difference which will happen, actuarial losses which will happen, actuarial profits which will happen depending upon the employees increase and decrease. So there will be difference both on the asset side and the liability side. I have to balance both the items and bring it to you. Probably I request the questioner to send a detailed mail, probably with an example. I will respond to them by way of a mail. Thank you.
Sure, sir. And those were the questions that came up, sir, and we'll see if there is any questions comes up, or else we'll close with the session. So 1 minute. It seems those were the questions, and maybe if there is questions, maybe after circulation of your recordings and this presentation, they might contact you or mail. So if there is any come up to our mail IDs, we'll be sharing it to your mail ID, sir. So you can respond.
Thank you.
On this. So our secretary has difficulty in joining the session at the end due to the network issue. So I take opportunity to propose vote of thanks for the session, sir. Thank you so much for excellent sessions around practical issues and accounting standards to AS9 and AS15, sir. And we, on behalf of SIRC, thank you so much in chairman and secretary absentials. Thank you so much.
Pleasure is mine. Thank you very much.
Looking forward to much more session like this, sir. Thank you, sir.
Thank you.